right, welcome back to episode 17 of the Cash Flow Corner. We're super excited to have on a special guest today, Tyler Lyons from Asym Capital. Tyler, how you doing?
Doing very good. It's good to see you guys. I'm really excited for the episode today. You guys are my Michigan brethren. So good to see you guys. I think this is going to be a ton of fun. I'm excited for it.
Yeah, we're really excited to have you on. I know it's been a kind of in the works the last couple months. I know scheduling's been a little bit of nightmare on both of our ends, but I'm really happy that we could finally get this out to our listeners and our investors. But before we get going here, just a quick little life update with Aaron and I. If you guys are tuning in on YouTube or maybe you're seeing some clips on our social media, things will look a little bit different moving forward. This past week or so, Aaron and I actually decided to part ways here in Scottsdale and get our own places. I'm currently living with my fiance and her dog, who I'm sure Aaron's thrilled to finally get away from the dog. So that's all good news on his end there. But other than that, yeah, we're trying to figure out all the lighting, all the new nuances to each of our new places. Your boy kind of needs a haircut here, but we're going to keep pushing through, and can't wait to get to this conversation today with Tyler. So with that being said, I kind of want to hand it back over to you, Tyler. Like Aaron was saying before we hopped on here, I know we've mentioned your name and Asym Capital in previous episodes. So there's probably a decent amount of listeners and investors who are fairly familiar with, you and Asym Capital, but maybe there's some new folks tuning in. If there's, any way to catch somebody up to speed a little more about your background, about how you got into the world of real estate syndication, I'll just throw it over to you if you kind of want to highlight some things about your background and go from there.
Yeah, absolutely. Happy to dive in here. And in my background, I didn't start in the world of real estate. Like many people, I kind of, lucked my way into it or found my way into it. My background, I'm actually an accountant by trade. I got a degree in accounting in college. I went the CPA route, worked for a large Big Four public accounting firm for many years. And after I left that job, I worked for a large publicly traded manufacturing company, joined their accounting team, and kind of climbed the ranks. And pretty early on in my career, I got promoted to a director of accounting and reporting, and I oversaw a large general ledger accounting team and oversaw SEC reporting for the company as well. So from all indications, kind of outside looking in, I was having this worldly career success at this particular company and was kind of growing my personal brand and doing that whole thing. But I found that I wasn't getting the type of satisfaction that I was hoping for out of that career. I was kind of a bit of a career crossroads because I'd put so much time and effort into thinking that someday I'd be the CFO of a publicly traded company. Like that's what I was always aiming for. And I kind of got to this crossroads about a decade or so ago, and I realized that that wasn't really what I wanted anymore. So it started for me a process of exploration. So I started reading books. I started listening to a bunch of podcasts, really just trying to figure out like, hey, look, is there a better way for me to direct my career in a way that just suits me better as a person? Because the company I worked for was terrific. I worked with amazing, smart people, and is a terrific experience, all things considered. But for me, it just wasn't the right thing. So it set me on this course of exploration. And I wasn't really sure what I wanted to do at that point in time. I was like, man, should I start my own business? Should I go buy an existing business? Should I buy real estate? What should I do? And eventually I kind of stumbled across the world of Bigger Pockets. Was actually an initial catalyst for me, again, about a decade or so ago. And
Yeah.
through listening to podcasts and reading books and connecting with some local people around my market in Grand Rapids, Michigan at the time, I kind of taught myself how to buy a duplex and renovate it and get it rented out. So I did that first particular deal and renovated it. I refinanced it, got it cash flowing. And it was a huge, it was a huge moment for me because I realized a few different things. I mean, first of all, I realized, and to be a little bit hyperbolic here, I realized that what everybody taught me about building wealth at that point in time in my life was all a lie.
Mm-hmm.
And I say that because in my personal opinion, what I've learned is that the process of stocking money away in a 401k for some future use, just hoping that I can kind of tap into it when I'm, in my late 50s and 60s, that just wasn't the right answer for me. And buying that first real estate deal and having cash flow deposited into my bank account while I was sleeping, is a complete paradigm shift for me because it shifted my thinking from this accumulation of wealth for a future date sort of mindset to let me find cash flowing assets right now to cover my living expenses right now. That way I can just have more life flexibility and pursue things that I want to pursue. So it's a big turning point in my life. And I realized, wow, I need to do this like 100 times more. Like I need to amp
Yeah.
this up. I need to buy more real estate. That was a huge turning point for me. And like many people who start out in the world of real estate, buying smaller residential properties, I worked on building my portfolio. I bought several properties. I scaled it up to several units. But you realize pretty quickly that buying these one-off residential properties, it's not very scalable. And when you're using your own money, I thought when I first started in the industry, I had to do everything myself. And when you're using your own money, you start to run out of money pretty quickly as well. So a couple years after that, I then discovered the world of syndication, and that was the next light bulb moment for me. So at that point in time, I started asking myself the question, okay, I've got a pretty good institutional background. I've hardened some skills over the course of the years in my career in accounting and corporate finance. I think I can do this stuff. I see some of these other guys out there doing it. I think that I can do this. So what's the best way that I can learn? So then I started diving into the learning side of syndication, started attending conferences, started reading books. I started investing as an LP investor in deals as well, because I wanted to see how sophisticated owners and operators thought about the process. How do they think about acquiring deals? How do they think about executing a business plan and basically creating compelling opportunities for investors? I wanted to see how they communicated with investors and how they reported. So I started investing passively in deals. And then I even went so far as to hire a personal coach who used to do acquisitions for a large REIT to teach me how to underwrite deals. So I started to dig into it. I joined a mentorship program as well. And through that mentorship program, I actually met Hunter Thompson, who's now my business partner. I didn't realize through joining that mentorship program that one of the potential outcomes would be to become a partner with the coach of the mentorship program. But that's what happened for me. So yeah, about 4 years or so ago, I joined Asym Capital and kind of worked my way up to becoming a partner at the firm. And that's kind of where I sit today. And at Asym Capital, we've had the joy and the opportunity to help over 500 accredited investors to invest in various different commercial real estate assets. And we've raised $100 million of LP investor equity, all retail investors, by the way, in terms of that $100,000. So it's a pretty big number in terms of retail equity. And in the last couple of years, we've really honed in our focus on the Phoenix multifamily market. And since we made that strategic shift and said, okay, the only thing we're going to do going forward is just Phoenix multifamily, we've acquired several properties, and we currently have about over $50 million in assets under management, and are really excited about the future. So that's a little bit about my background, my story, and kind of how I got into the world of syndication.
Yeah, that's amazing. And it's crazy to think that in your journey, in your story, I can see myself and Jacob's in there as well. And it's somewhat blended because right now we're a little bit similar in a way that we have two rentals right now that we're running as short-term rentals. And it's a great starting point, but know that we knew that syndication and more specifically multifamily was always our goal and always what we were really striving for. So just to be able to kind of reflect even on the past year while we went to Race Fest just about a year ago, saw you, Hunter Thompson, up on stage and was just like, I would love to just meet these guys, to introduce myself, get in their circle, and then look back or fast forward a year later, partnering with you guys on this latest deal, and then being along for this latest Race Fest. I mean, it's just such a whirlwind over the last year, and really to see the same steps I feel like you were taking maybe while you were in our position of just trying to educate yourself as much as possible, take those courses or get mentorship and join a mastermind group to ultimately just, I mean, be that sponge of all that knowledge to try to gain as much as you can. So, I mean, whenever you are going into these deals, you can be as confident as possible. And then, like you said, you just want to keep doing them and do 10 more of them. So, yeah, I love to hear that. And
And
then I guess,
kudos really quickly, kudos to you guys too on your progress so far, because like hearing that arc of like going to Raise Fest and then observing like everything you guys have done, like completing your first raise, like all the growth you guys have experienced in just the last year alone, it's really impressive, and it's quicker than my first year. And we can talk about the reasons therefore, but I just wanted to give you guys kudos for the progress you've made. It's awesome.
yeah, I
Thank you.
appreciate it. And I know, I mean, it was a big help to you and Hunter with Raise Masters and that whole group. I mean, I just feel like once you get together with like-minded individuals, I mean, I feel like everyone just flourishes so much faster, and it's so much easier to kind of bounce ideas off each other, and really, I mean, all together as a group to kind of elevate ourselves, which has been great for us. But then, yeah, on the ASIM side, we're very excited to partner with you guys on this latest deal. Then I would say from that side, what does, I mean, your role now at ASIM is Chief Investment Officer. I would say, what does that role look like in real estate syndication?
Yeah, so to give you just a kind of a peek behind the curtain in terms of what I do at Asym Capital, it's pretty similar for other kind of emerging and middle market multifamily syndication firms as well. But as chief investment officer, there are a few different buckets that I oversee and that I'm intimately involved with just on a day-to-day basis. So first of all, on the acquisition side, I am responsible for making sure we have deal flow. So from a deal flow perspective, building the relationships and building that trust with the brokerage community here in the Phoenix MSA, building trust and relationship with other owners and operators in the Phoenix MSA as well. Everybody kind of talks about brokerage relationships for deal flow, but I think equally, if not more important, is knowing the other owners and operators in the market, because you can get off market deal flow if you know the other people who own the deals. But then furthermore, imagine you're in a best and final scenario. You've written an offer on a deal and you're competing against other people to get the deal. If you golfed with the owner last weekend, or if your kids like are hanging out, like playing together in the backyard the weekend before, chances are, if you have that trust level with the person who's selling the deal, you might get chosen even if you're not the highest bidder. So that's part of it, is deal flow and acquisitions. And another part of the deal flow process as well is the actual underwriting process too. So we get sent deals from all different directions pretty much on a daily basis. In fact, we've really seen deal flow just kick up in a big way the last 2 weeks here. I don't know if the levee is breaking or what, but it's been super duper interesting from that standpoint. But the underwriting process too, like the spreadsheet analysis of, okay, we got the rent roll and the trailing 12 financial statements and the offering memorandum from the broker. What do we do with that information? Kind of getting that through our underwriting model and really figuring out at what purchase price the deal is viable, designing what the business plan is going to be for that particular acquisition. So that underwriting process is a big part of my team as well. Also, the portfolio and asset management side of it as well. I oversee asset management, so kind of overseeing the properties, overseeing the third-party property management companies, the execution of the business plan, the general contractors who are coming in and doing the renovations and the things that we need them to do. The asset management side of it is really big. But then also on the investor relations side too, kind of more of the reporting element of the investor relations side. I do assist with raising capital for sure. I'm definitely involved in that process, but that's a little bit more my business partner who's focused more on the raising capital side. But there's the kind of the investor relations side of it as well. Those are the main buckets of things that I focus on a day-to-day basis at Asym Capital.
Yeah, no, that makes a lot of sense. And something that really, Aaron and I gravitated towards you and Hunter is you can see the obvious chemistry and, just putting you two together, it really works, and you can see it from afar. And also, having the chance to work with you guys firsthand, you can definitely see it. That I kind of use the analogy of like, you're kind of the offensive line, you're kind of in the trenches doing a lot of, the behind the scenes stuff that a lot of people don't see. Whereas Hunter's on the marketing, on the social media, putting his face out there, which is, you need both of those things to really push the business forward. So that's something I've always really loved about you guys, and something that Aaron and I are trying to implement into our business, is being able to divide those duties and responsibilities up in between each other. That way, you can keep driving the business forward as you best see it fit. So I love that. And then just kind of transitioning here topics a little bit as we start to look into evaluating, like you said, the deal flow that's kind of currently coming in. I know in the past it's been something where you guys typically look for value add strategy approaches, but as you know, over the past year and a half, those opportunities have been few and far in between as of late. But hopefully things start to flip the corner here, like you kind of mentioned. So with that being said, how do you typically approach value add strategies to maximize returns, and what are you looking at right now as we get into the year end of 2025 and so on?
Yeah, it's really interesting because these things kind of go in cycles in terms of what kind of deals actually work at any given point in the market cycle that you might be. Because when you look at the period from, call it, 2012 to 2020, a lot of people were going in and doing these deeper value adds where they would go in and do a bunch of interior unit renovations, and people just made a ton of money doing that. And what we're seeing right now in the market cycle is that the traditional value add of kind of going in and doing that strategy, it's become more and more difficult to get that kind of stuff to work. And that's true for a few different reasons. First of all, the cost to do renovations has gone up pretty significantly. I actually had the chief investment officer of a $2 billion firm on our show recently, and he was kind of talking about, look, I remember underwriting these things and budgeting $6,000 per unit for a renovation, and now we're looking at, call it $15,000 to $20,000, which that's kind of what we're seeing too. The
Mm-hmm.
cost to do the renovations is significant. It's gone up quite a bit. But then also in terms of so if the cost to do a renovation is that much, I mean, you need about $300 to $400 of uplift in rent in order for that to kind of pencil and make sense. So
Mm-hmm.
that makes it a bit more difficult to get that traditional value add to work. Another thing that makes it a little bit difficult as well is that bridge financing is really expensive, because if you have a deeper value add sort of property, you might need to acquire it with bridge debt financing. And while the
Mm-hmm.
spreads on bridge debt financing have come down quite a bit the last several months here, it's getting more attractive. Bridge debt financing, the interest rate is a lot higher than, for example, getting agency financing through Fannie Mae or Freddie Mac. So because of those reasons, it's become difficult to get that traditional value add sort of strategy to work. So what we've seen that's worked really well, the last three deals that we've done have been more of this profile. It's more of a lighter value add strategy where you're purchasing a property that's already in pretty good shape. But there's some things that you can tweak here and there to expand net operating income, to improve the property, and you can buy it. And because it's stabilized and already in pretty good shape, you can acquire it with fixed rate agency financing right out of the gate.
Mm-hmm.
So, for example, I think back to the last couple of deals that we did. They're deals that are already renovated pretty heavily. Like they've already received pretty significant capex dollars. And I'd call these deals almost, I think it'd be appropriate to call these deals failed value add
Yeah.
deals.
Yeah.
Not because the owners and operators didn't put capex into it. They did, but it's a failed value add because these owners and operators, they didn't get the rent growth that they hoped to get. They're having issues with debt maturities that are forthcoming. So it's kind of a failed business plan. And now we're able to come in and purchase these properties at a great basis. They've already received significant capital expenditures. So we're coming in and making some tweaks here and there. There might be opportunities to roll out ancillary income programs such as,
Mm-hmm.
bulk Wi-Fi, valet trash, reserved parking. There might be strategies like that. There might be opportunities to further optimize economic vacancy and just improve the top line from a vacancy perspective. And then also, there might be opportunities to improve the amenity package of the property as well. And when you're doing something like that, it's difficult to underwrite or to tie a specific rent increase to something like that.
Yeah.
So for
Sure.
example, the deal that we did in Peoria about a year and a half ago, there's a huge storage shed at that particular property that was just going unused. We converted that to a gym, and that's going to improve the competitive positioning of that property over the course of the last several years. So that's really what we see that works best right now at this point in the market cycle. You do sometimes see, they're few and further between, but you do sometimes see these long-term ownership deals that are kind of the true value add that we've seen kind of in that 2012 to 2020 timeframe. And then the
Right.
last one I'd mention too is that new construction deals as well, and new construction deals where similarly some of these developers who are building deals to sell and not own and operate, um, they need to sell these deals sometimes below what replacement cost is. So if you
Hmm.
can come in and buy these deals below replacement cost and still carve out a pretty good yield that can be a really interesting opportunity as well. So at Asym Capital, we're a market specialist. We focus just on a single market. So we're considering and execute different strategies in this market. Like we're not the group that says like, okay, like this is the same exact playbook that we go and execute across many different markets across the country. We believe in being hyper focused on a single market, knowing kind of that street by street sort of knowledge like we have, and executing and being opportunistic on the strategy that we execute. But high level, those are kind of like the three different buckets that I'd say that we're looking at opportunities actively in the Phoenix MSA right now.
Yeah, I mean, that was one of the biggest things for myself and Jacob to move here as well in the Phoenix area, just knowing this market and really understanding the market as a whole from, I mean, not just the valley as a whole, because I mean, there's spots and pockets everywhere. I mean, throughout where there's different strategies that can be implemented and ran to be successful. So really just trying to hone that in. I know, I mean, that's what me and Jacob have been doing a lot recently is a lot of market overview and really figuring out which strategies. Because even for us, even though we talked about it whenever we first moved here, the apartment that we were living was up for sale, and we're like, man, I wonder like if I was the buyer, if I were a potential buyer going in on this deal, just underwriting this deal and see like, okay, where would I come in? So, I mean, even knowing that me and Jacob we don't have $110 million in the bank or in the back pocket to maybe put into
Not
that
yet, at
deal,
least, not yet.
but just I mean give ourselves I mean education and feeling of okay, like what would we do in this situation, and I feel like that's been helping immensely throughout the deals that not only come our way and we underwrite ourselves, but just putting ourselves in the shoe as that lead operator. And then I guess the same for both of us of being bullish on Phoenix, like you mentioned, of really figuring out what strategy works best.
Yeah, and
And
we're
then
also, I was going to say, happy that Hunter announced that he's going to be moving here. Not sure what the timeline is on that yet, but we're excited that he's making the move out here. So we're looking forward to that as well.
It's going to be a lot of fun. I'm looking forward to
Yeah,
it
that's
too,
going
for
to be
sure.
exciting. That's going to help both of us out as well. Then, kind of going off like that same footing, I guess, could you break down the due diligence process? I mean, specifically for multifamily acquisitions?
Yeah, absolutely. So when we tie up a deal and actually get it under contract, we kick off a due diligence process that most times it's going to be a 30-day process. That's kind of the industry standard where basically we're going to come in and look at various different things to make sure that it's all up to par before we actually close on the deal. And when I think about due diligence, I think about it in two different buckets. There's kind of the operations and financial due diligence side, and then there's the physical plant due diligence side. So when we get a deal under contract, basically what we're doing, and we're typically letting our service providers know a little bit ahead of time too before we actually get something under contract so they're ready to rock and roll. But when we get a deal under contract, there are different stakeholders that we let know. We let the third party inspector know that we use for this kind of stuff. We let the third party property management company know. We let our general contractor know. We give all these people a heads up because when we get a deal under contract, we then go on site for our due diligence process. And there's a few different things that happen in that process. First of all, the inspection company is going to go through and we're going to walk 100% of the units with the inspection company too. Like I'm not going to buy a deal unless I can stick my head and look around in every single unit on a property. So we walk every single unit with the inspection company, and the inspection company, they look at basically every aspect of the physical plant. They're going to look at the roofs, they're going to look at the building envelope, they're going to look at the major mechanicals, so the heating and cooling systems, the electrical, the plumbing. They're basically going to crawl all over every single square inch of that property. And what they do then is they produce a detailed report for us so we understand, okay, here is the condition of the property. Here are the immediate things that need to get fixed right away. Here are the things that you need to think about that might need to get replaced in the future. So they put together a comprehensive report of that information. And at the same time, we're walking the property with our general contractor as well. So we can kind of go through, okay, here's our business plan, and here are the things that we're planning on doing. We're planning on putting, hardwood floors in the first level units. We're planning to install a dog park. We need to replace these barbecue stations, all that kind of stuff we're going through with our general contractor as well. So that's really kind of more of like the physical due diligence side of it. And then more of the finance and operational due diligence side of it is we're going to do a lease audit as well and verify that all the leases are actually accurate. Like, here's our rent roll that we received that we based our underwriting on. We need to go through and audit every single one of those leases to make sure that it's accurate. We obtain the bank statements for the last couple years and basically tie out like, okay, here's what you're saying the collections were. Let me see the bank statements to make sure that's true and not fraudulent. Obtaining the Schedule E's from the tax returns and seeing what they reported from a tax perspective. Does that make sense and hang together based on what they're saying the property operations were? So that's kind of more of the financial and operational due diligence side. And as a tie into that, we're also looking at our underwriting assumptions as well, because we built a business plan and said, okay, here's our business plan. Here's where we think we could take the revenues and expenses. And because of that analysis, here's what we think we can pay for the property. When we're doing the operational and financial due diligence, we're going back and revisiting all of our underwriting assumptions too, to make sure like, okay, here's what we had for contract services. Now we reviewed all the contracts. Like, is that accurate? Here's what we had in the rent roll and therefore what we projected from a rent perspective. Well, now we've completed the lease audit. Is that accurate? So we're kind of firming up all of those underwriting assumptions as well, including the capital expenditure side, because now our general contractor has walked the property with us. He's given us estimates of what it's going to cost to fix everything. So we're kind of making sure our business plan is accurate as well and making little tweaks where necessary.
Yeah, thank you, Tyler, for taking a deeper dive there into your guys' due diligence process at Asym Capital. I really appreciate you getting into the nitty gritty of everything that goes on from start to finish, and it's something that goes unseen a little bit, but being able to learn a little more about that process, I feel like is going to provide a lot of value to our listeners and our investors. So thank you for that. But kind of pushing and transitioning the topic here a little more, I kind of want to talk about market trends and strategies that you guys are currently seeing. And with that, as you've already mentioned a couple times with Asym Capital, you guys are solely focused on the Phoenix MSA here in Arizona. But with that being said, how do you guys typically go about evaluating potential, let's say maybe different submarkets in the Phoenix area? What are some metrics or key data points that you guys are looking at?
Yeah, it's a great question. It's an important question. I'm glad you kind of framed it the way you did too, Jacob, because we're not the operator who's out there evaluating many different markets and investing in many different markets. We're solely focused on the Phoenix MSA, and we can always talk about the reasons for that if you'd like to. There's a ton of market research that went into choosing Phoenix, but in terms of more of that sub-market by sub-market sort of analysis, when we're thinking about where we want to put some chips on the table, and also there are certain sub-markets too that we've completely redlined, and it's like, okay, we're not going to invest there. It's just not worth the time and the heartache and the headache. But there are a few different things that come to mind here. Some that are pretty quantitative and scientific, and others that are a bit more kind of gut feel. But first of all, I'd say the most important thing that we look at is median household income in a 3-mile radius of the subject property. Because median household income and how much the folks who live in that particular submarket make, it's going to tell you a lot about the demographic. And there's a lot of other things that are downstream from household income. For example, crime. The higher the household income, generally, the lower the crime level is going to be. The lower the household income, generally, the higher the crime is going to be. It's just kind of the way it is, right? So that's one thing that we look at that's really important. And it's really important to study and analyze what that median household income is as well, because when you're building a business plan and you're developing the pro forma rents for a particular property, you want to be certain that you've got a good rent to income ratio, because you want to make sure that you've got the type of demographic that can actually achieve those pro forma rents, that can actually pay for those pro forma rents, right? I mean, if you have a business plan or a property and the pro forma rents are just completely on a different planet than what people are making there, you might want to pause and take a second look, right? I mean, it might not be a total deal breaker, but it might. That'd be something you'd want to pay very close attention to. So that's something that we look at that's really important. Also, given that I live in the market and obviously spend a lot of time here, I've had a lot of time to drive the streets and spend time in the restaurants and the bars and various different areas throughout the Phoenix Valley. So I've really got a good thumb on the pulse in terms of having the local knowledge to supplement the numbers, to supplement that median household income. We look at crime maps too and kind of see where there's more crime happening, where it's safer, that sort of thing. So being able to cruise the neighborhood, spend time there, that's been a big part of it. And what might that look like anecdotally, just in practice? A really good example that we literally just talked about just this past week in our internal underwriting discussions is we had a deal sent our way from a broker and is a little bit outside of our buy box, given as a little bit smaller, as a little bit older of a property. But there are a couple things that I did like about it. First of all, it had low interest rate assumable debt, which is great. But also, it was in a submarket that I spent a decent amount of time doing some market research just recently. About a year and a half ago, we had a broker send us a deal, and I studied and scouted that particular market, drove the streets, and I actually spent some time hanging out at a local coffee shop there that was about a quarter of a mile away from the subject property. And I felt very comfortable. It was a very cool vibe at that particular coffee shop. I spent there the afternoon working there, and it's one of those things where this isn't very scientific, but if a property in a neighborhood kind of passes that coffee shop hangout sort of test, like that feels pretty good to me. So for us, there's some stuff that's pretty quantitative and scientific that we look at, but then there's also an element of just spending time in certain areas and understanding it from a gut feel perspective as well.
Yeah, that really is such an advantage to be able to really focus on your own backyard because you get that feeling of being able to really see the neighborhoods and the markets and know what it feels like just because that's how me and Jacob really got started whenever we moved out here trying to figure out where we wanted our rentals to be. One of them was right down the street from TPC Scottsdale. Like, oh, we love this area, we know this is going to be a great hot area, so let's just go in on that. And the other was a little bit more quieter community, still in North Scottsdale, but got that feeling it was nice, safe, it was family friendly. So I know that especially investors might not know like that's all that really goes into other than just the numbers of getting the market overview and everything like that, but being able to actually have boots on the ground to take a look, and it's such an advantage. And I know investors will really get a kick out of that and really enjoy. That's a big part of breaking down a deal.
A little more color on that point too, Aaron, before we leave it, because I think it's super important. Because you're always, as an investor, you're always trying to balance. Okay, let's say that you're right in the middle of a very established and mature area. Let's say that you're buying a multifamily, in North Scottsdale, or in some really good area parts of Gilbert or something like that. There's going to be a premium to own in that particular area, right? So, but when you look at the world of real estate, there have been people over the course of decades who have made so much money kind of buying on the line, in that
Right.
path of progress. And I feel like that's where we really shine too. If there's groups from out of state or from New York who aren't local here, who are coming to try to come into town and buy, they're not going to have that street by street knowledge that we are. Just as another example from some of our underwriting and pipeline conversations the other day, we looked at a deal recently and it was in a pretty solid area. And immediately north of the property, you had some nice condos and whatnot. But then on the other side of the condos, you hit a lot of trailer parks, and it's just really, you hit a different demographic pretty quickly.
Yeah.
And but then if you looked south of that particular property, right across the street, I could hit a golf ball out of the front yard and have it land in the lawns of $1 million homes.
Yeah.
So then we looked like this property. It's like, okay, like I like this story. Like that's pretty good. Now we saw a property just hit the market the other day that was north of this property and was immediately adjacent to the trailer park communities and kind of like that rougher area. So somebody who's just looking at deals from afar, they might think that these properties are the same and might pay the same for the property that's right next to the trailer parks. And when we've got the market knowledge to know, like, no, the property that's further south, that even though it looks like it's in the same submarket, because of that street by street basis, like that one is much better. Like I would rather have that particular property. So just wanted to share a little more color on that, just on the importance of having that like acute, detailed knowledge of what's going on in the submarket.
Yeah, another huge advantage of being in your market, especially for ASIM, like having your one single market be your backyard is such an advantage. And I feel like that really falls into maybe our next question, as if you were starting over today or you were starting to passively invest in your first syndication deal, I guess what would you do differently or what would you look for?
Yeah, that's a really good question. I'm glad you asked. Let's piece it into two different questions. Like, first of all, in terms of what would I do differently when I started my real estate journey? I would have partnered much earlier on. I spent 4 or 5 years thinking I had to do everything myself, thinking I had to find the deals myself, capitalize the deals myself. I spent way too much time doing that, and if I would have found the world of syndication earlier and really understood the power of partnering earlier on, it would have sped up my career trajectory so much faster. Because that's something, again, like kind of going back to the earlier part of our conversation when I complimented you and Jacob, Aaron, was that you guys figured that out early. Like, look at the progress you've had in a year. Like, you're already raising money and participating in large commercial deals because you decided to partner earlier, because you partner with experienced folks like Hunter and I. um, it's really sped up your trajectory in the industry, where for me, I still own some of those properties to this day that I bought back in the day. So I'm happy. It makes my personal balance sheet strong. But at the
Yeah.
same time, had I started to partner earlier on, I'm certain that my trajectory would have been much quicker. Now, from a passive investing perspective, if somebody is new to passive investing, looking at passive investing, I think it's really important to pick a lane and make sure that you understand that particular lane very thoroughly. Because I think a mistake that people make when they find the world of passive investing, when they find the world of syndications, they get a little bit too trigger happy and start allocating into a bunch of different deals. Like, okay, I'm going to invest in this multifamily deal with this particular sponsor. I'm going to invest in self storage over here. They might start investing in non real estate alternative assets that have a whole host of different risks that are really hard to understand and hard to see if you're not a professional investor. So, what I would recommend is pick a lane, pick something like multifamily that's tried and true, and really understand that particular investment strategy cold. Know what the risks are. Interview, folks like Aaron and Jacob, interview folks like me, and really try to dig into and understand what the risks are and what could go wrong in these particular deals. And stick to that for a while before you start venturing off into something, because I've seen people get burned trying to diversify and allocate just a bit too broadly, a bit too soon. They don't truly understand the risk profile of some of these deals that they're getting in, and that can really create some problems. So that's what I would recommend for people who are, kind of just getting into the syndication space.
Yeah, I really love that. And like you said, going back to the start of, like you said, there's only so much you can do on your own up until a point where you need to start to bring team members on. You really need to start evaluating how you can essentially push your goals even bigger than what you thought. And that was the same thing for Aaron and I when we first moved out here. What was that, 2 years ago? We got our first couple of Airbnbs. And we're like, yeah, this is awesome. Like, we're going to keep growing this. But then we quickly looked up and we're like, oh, shoot, we're out of capital. Like, where do we go now? And it's like, you can only get so far on your own before you really have to start reaching out to other people, building teams out, systems out, because that's what's going to, propel and push your business forward at the end of the day. And I like the piece of advice that you had. Maybe if somebody's an LP getting into one of their first deals, of trying to just find a lane and stick with it. That's something Aaron and I, we gravitated towards multifamily pretty quickly, and that's kind of the path that we've taken. And now we're on the train tracks, as I would call it, and we're pushing forward with that. But just to kind of go off that, kind of looking at trends or future investment projects here in the Phoenix area, what are some of the trends maybe you're seeing that are shaping the commercial real estate syndication future here in Phoenix? I know I might steal an idea here from you, but I know the Taiwan Semiconductor, what did they just pledge, about $1 billion here into the Phoenix area? I think that was a couple of weeks ago, so that was huge news for us. But is there any kind of trends that you're seeing that could help bolster Phoenix within the next, call it 2 to 5 years or something like that?
Yeah, man. In terms of the Phoenix specific discussion around where things are going and what's exciting, Taiwan Semiconductor is something that is on a scale that is truly tough for me to even wrap my mind around. And I don't think people truly understand the scale of what it really means,
Yeah.
because Taiwan Semiconductor initially committed $40 billion to build a chip manufacturing facility north of Phoenix, which is already in progress. Like they've got a bunch of fabs and stuff built out there already. Like it's blowing and going. You can see it from the road.
Huge.
It's massive. Because step back and think about it this way. If you're in a market and you see some commercial real estate development, whether it's an industrial property or a shopping mall, if you see a development that's a $500 million development, that is huge, right? Like that jumps off the page. Like that hits headlines. That's like, holy cow, I don't think I've ever seen anything that big being built. Like that's a really big development. So the fact that, they committed initially $40 billion, which they subsequently increased to $65 billion. And at that point in time, this was the largest direct foreign investment in United States history. And then they recently announced that they're increasing this investment another $100 billion.
That's what it was. I was off 100 billion. Yeah, right.
100x. Yeah. So yeah, it's going to be a $165 billion manufacturing facility in North Phoenix. And I've seen some of the renderings around what's going to happen around Taiwan Semiconductor. It's really going to be a city within a city up there. And to just think about the thousands of jobs that Taiwan Semiconductor directly is going to create, high paying jobs as well.
Yep.
And that's just a piece of it. The industries that are going to support Taiwan Semiconductor, the service providers that are going to need to support even those industries as well, the residential housing that's going to be needed, the bars and restaurants that are going to be needing, the shopping that's going to be needed. It's really just crazy and insane what's going on up there. So you've got that going on up there. On the west side of town as well, that's a huge path of progress area as well, because on the west side of town, you've got Highway 303, which is, for all intents and purposes, a new highway. I think if you're investing in markets where new highways are being built, it's a pretty big green light that there's a lot going on. They need to build new highways there. Highway 303, if you drive down it, it's really remarkable. It's manufacturing and distribution facilities as far as the eye can see.
Yep.
There's hundreds of them that have just sprung up the last several years there. And the thing that's really interesting is that the west side of Phoenix, it is an 11-hour drive from the port of Long Beach. And with the laws and regulations around trucking, like truckers basically have to shut it off after a 12-hour drive and rest for the day. So the fact that you've got a stop that's 11 hours away from the port of Long Beach, and it's a way more business friendly sort of environment than anywhere in California, you're seeing a ton of different companies right now building massive distributions on the west side of town. Think Avondale, Goodyear, Buckeye.
Yeah.
These areas are just exploding, man. Buckeye is I think it was from 2018 to 2022 as the fastest growing city in the United States. It grew by like 54% over that time frame. So yeah, you've got a market right now where in many different pockets, it's experiencing hyper growth. And of course, people talk about the supply situation at Phoenix. And yeah, the market has seen a lot of supply, but at the same time, it's seen record absorption as well. And right now, we're at a point in time where we're seeing we're basically in peak deliveries right now. So in terms of the supply pipeline, it's a steep down and to the right from here on forward. We're expecting 20 to 25,000 units to be delivered this year, 10 to 12,000 next year, and the year after that, you won't believe this, 1,500 units. So we're trying to get ahead of it at Asym Capital. Like now is a great time to buy. It's a difficult time to operate, but now is a great time to buy because look, in 2027 and 2028, it's going to be a great time to operate.
Yeah. That's something that Aaron and I have talked about, the past couple episodes on this podcast is being able, especially for us, being able to partner with good operators in bad times. Because it's something, if you can operate a property in bad times, there's no telling what an operator can do when things are well and things are doing good. So I feel like that's got us really excited to partner up and continue to develop our relationship with you guys at Asym Capital. So we're super thrilled about that.
Love it. And the feeling's mutual too. It's been like I said, it's been super fun to see your guys' growth. And honored to have you guys as a partner in our last deal, and looking forward to many more in the future for sure.
Yeah, we're excited as well. And I mean, I think this has been a great conversation, and our listeners are going to really love this. And I guess the last thing would be, where can our listeners maybe learn more about you and your future opportunities?
Yeah, if you want to shoot me a follow on LinkedIn, if you search Tyler Lyons Real Estate, I'm really easy to find on there. I'm getting a bit more active posting on there, and I love talking about Phoenix multifamily real estate. Give me a follow on LinkedIn. You can find our deal flow that way as well. And very easily, too, you can visit asymcapital.com, asym capital.com. You can basically create a profile there, and that will allow you to see all of our investment opportunities. So, yeah, looking forward to connecting with you guys in the future. And I love talking about this kind of stuff. So if anybody ever wants to talk shop, feel free to reach out to me.
Love it.
Perfect. Yeah, and I know we'll in the descriptions and the things below, we'll try to attach as many things as we can for you on there. That way, it's a little easier for everyone to find it that way. But I feel like, Aaron, is there any kind of closing questions or anything you want to say before we hop off?
No, I think that's a great place to wrap up for today. Tyler, thanks for coming on, and really appreciate it.
Thanks, guys. This has been a lot of fun. Really appreciate it.
Thank you.